Welcome to Lesson 6. Today we cover interest rates and bonds, and they matter because rates are the master control knob that moves the price of almost every asset. We'll learn while watching the U.S. 10-year Treasury yield chart on your screen, TVC, U.S. 10Y monthly. When this chart climbs, markets around the world feel it. Once you understand rates, questions like, why did stocks rise or fall, and why did currencies shift, suddenly snap into focus. When the news says rate hikes are expected, you'll be able to read a chart like this one and anticipate how markets may react next. Ready? Let's walk through the chart together. Interest rates are simple. They're the price of borrowing money. Just as coffee has a price, money has a price when you borrow it. That price is interest. Concretely, if you borrow $10,000 and pay 5% to interest after 1 year, the price of money was 5%. The higher the rate, the more expensive it is to borrow. The textbook chain looks like this.
레이츠 고 업 그러면 론즈 겟 프라이시어 그러면 컴퍼니즈 앤드 하우스홀즈즈 보로우 레스.
Spending and investment cool off, and the economy slows. Cut rates and borrowing gets cheaper, so activity heats up again. That's why the Fed and central banks everywhere adjust rates. They're dialing the temperature of the whole economy. Watch the rate trend on this chart, and you can see that chain in action. A bond is basically an IOU. A government or company says, lend me money, and I'll pay you interest on a schedule. Treasuries are issued by the government and sit near the top of the safety ladder. Corporate bonds are issued by companies and carry more risk. Buy a bond and you receive interest on set dates. A high credit name like Apple or JP Morgan pays a lower coupon. A lower credit company has to offer a higher coupon or investors won't buy. Historically, safer bonds get accepted at lower yields. Think of the interest rate as the price of risk. Stocks swing hard. Bonds are steadier. Mixing bonds into a portfolio can lower overall volatility. Here's the pattern that really matters. Keep this U.S. 10-year yield monthly chart in mind. When rates rise, the price of bonds already outstanding falls. Picture it. You're holding a bond that pays 3% and brand new bonds now pay 5%. Nobody wants your 3% bond unless you cut the price. That's exactly why rising rates push bond prices down. And when rates fall, your older, higher coupon bond suddenly looks rare, so its price rises. Rates and bond prices move like a seesaw. That inverse relationship is one of the core laws of investing. Higher rates are generally tough for stocks, including names like Apple, Nasdaq, AAPL, on this chart. There are three main reasons. First, companies pay more interest on debt, so net profits shrink. Second, safer bank deposits and bonds suddenly look more attractive, and investors sell stocks to rotate into them. Third, when you discount a company's future cash flows to today's dollars, a higher discount rate, higher rates, means a lower present value. Put simply, a promise of $100,000 in 10 years looks rich at 3% rates and cheap at 8%. Not every stock feels the same hit. Heavily indebted firms take a harder punch. Debt-like growth names or fortress balance sheets can react differently. Markets often rally stocks the moment they expect cuts, pricing the future early. If that expectation fails, prices can reverse just as fast. When you invest, judge both the level of rates, high or low, and the direction, rising or falling, at the same time. Now, let's zoom out to the big macro picture, a chain that has repeated through history. When inflation rises, the Fed tends to hike rates. Look at the U.S. dollar index, TVC, DXY, monthly chart on screen. After U.S. rates climb, the dollar often strengthens. Higher rates make dollar deposits and treasuries more attractive, so global capital piles into dollar assets. The dollar gets stronger and other currencies weaken. Foreign investors then sell local currency assets, including equities abroad, and rotate back into dollars.
프라이시즈 그러면 레이츠 그러면 FX 그러면 스톡스.
That chain sits underneath almost every market headline and asset swing, and it's the key takeaway. Let's recap. Interest rates are the price of borrowing, and the Fed dials that price to set the economy's temperature. The 10-year yield trend on screen shows those shifts in real time. Bonds are IOUs from governments and companies, and when rates rise, bond prices fall. That inverse link is a market fundamental. Rate hikes hit stocks three ways: higher interest expense, a rotation into bonds and cash, and a lower present value of future earnings.
더 매크로 체인, 프라이시즈 그러면 레이츠 그러면 FX 그러면 스톡스 민즈 원 헤드라인 캔 리펠 어크로스 글로벌 마우키츠.
This lesson is for education only, not investment advice.
넥스트 업인 레슨 7, ETFs and Diversification.
Hit like if this helped.